Right now, retail traders are pouring capital into what look like promising crypto bounces, but beneath the surface, the broader economic foundation is fracturing. This 4-hour S&P 500 chart shows a massive structural pullback. This downward momentum dictates all risk assets, including crypto. As traditional finance players de-risk, automated algorithms sell equities, immediately dragging down highly correlated crypto markets in perfect synchronization. This gravitational pull completely overrides standard crypto momentum. Any short-term upward price action in Bitcoin right now is likely a trap, artificially propped up before the larger macrogravity takes over. On weekly and 3-day timeframes, Bitcoin is flashing oversold signals that would typically suggest a massive relief rally. But immediate, aggressive downward pressure from the equities market is overriding those traditional bottoming indicators entirely. If you ignore this macroeconomic tether, you are playing a dangerous game. Buying these false bounces simply provides institutional players with the exit liquidity they need to safely exit their own positions. We can see this exact dynamic playing out with Bitcoin right now. Over the last few days, the price slammed into a massive resistance barrier between $72,000 and $76,000 and was violently rejected. This animated diagram shows exactly where the market is heading next by mapping the liquidation heat map. A liquidation heat map is a visual tool that plots where traders have placed their stop losses and leverage levels. This essentially creates a map of trapped retail money for institutional predators. Look closely at the data building just below the current price. There is a massive concentration of liquidity forming in a tight band strictly between $68,000 and $68,700. Large institutional forces know this money is sitting there. They actively use the weakness in the S&P 500 as a smokescreen, allowing them to push Bitcoin's price downward, triggering retail stop losses to harvest the capital. This leads to two immediate scenarios. The first is a Wick hunt. Here, the price drops like a needle straight into that $68,000 zone, instantly wiping out the retail positions before retracting upward and leaving a long tail on the chart. If the price bounces quickly and holds support above $69,000, it signals that the market makers have collected the liquidity they needed. That rapid reset often provides the clearest buying opportunity for informed traders. The second scenario is much more dangerous. If the 4-hour candle completely closes below the critical $69,000 support level and fails to bounce back above it, the market structure breaks entirely. Once that floor gives way, there is very little stopping the fall. The price will rapidly cascade downward to find the next structural base, which currently sits between $65,500 and $66,000. The current price action is detached from organic value discovery. We are watching algorithmic predators systematically harvest retail panic at carefully engineered price floors. Bitcoin's engineered liquidity hunt does not happen in a vacuum. It creates a toxic contagion effect that mechanically drags the altcoin ecosystem down. Take Ethereum. Over the last few days, it lost its grip on the critical support level at $2,150, officially confirming a daily candle close below that threshold. Ethereum's chart shows the mechanics of flipping support to resistance. It dropped below the rigid $2,150 line, attempted to cross back above, and was violently deflected downward, cascading toward the next immediate buyer levels squarely at $2,070, and below that, $2,010. We see the exact same bearish confirmation playing out on Solana. After facing a hard rejection at $105, it completely failed to hold its short-term floor at $88.70. Driven entirely by the overarching macroeconomic gravity, Solana is now cascading towards its next downside targets of $86.70, with a further drop to $84.50 highly probable. Chainlink is showing a similar breakdown. Whole numbers like $10 act as massive psychological walls for traders. After failing to break that $10 ceiling, Chainlink is collapsing back towards its established support at $7.90. Then there is XRP. It suffered a breakdown from $1.47, actively testing the $1.43 support. Once that line breaks, sliding straight into the $1.30 range. But if we zoom out to a 6-month view, the true scale of the market structure reveals itself. The ultimate accumulation zone for XRP, the golden pocket where serious institutional money is waiting, is resting way down between 30 and 40 cents. Surviving this market requires accepting that short-term price action is driven by algorithmic manipulation. The only way to win is to refuse to buy the fakeouts, keep your capital safe, and wait patiently to deploy it at the absolute macro floors.